Amalgamated Appliance's first half basic earnings per share increased by 132% to 29 cents. This after the recovery of losses received from an arbitration award were taken into account. Revenue increased by just under 17% to 526 million rand. And joining me in studio now to discuss Amalgamated's performance is the company's CEO, Alan Coward. Alan, thanks so much for joining us this afternoon. Well, that's pretty much summarizing a little bit of the year that was for the company. Over and above that, we saw revenue growing 16.6%, operating profit increasing just over 5% as well. But it's the volatility during this period of the exchange rate specifically that's created immense margin pressure for a company like yours. To what extent? So let's start off at that point.
The difficulty of managing a volatile exchange rate is going to live with us, I guess, for forever in the South African market. And you've got to watch it. You've got to get everybody on board with it and put through price increases, price decreases, and just manage it appropriately.
I ask, and I started off that point specifically because it's within an environment that's become extremely competitive within the South African operating environment. So run us through that competitive landscape right now, especially with the Massmart Walmart tie-up entering the fray.
I think the nature of the rules have now changed in the market. It's about looking at the consumer and giving the consumer value for money. So what you have to do is you've got to work with the retailers to combine forces so that you share your overheads with the retailers' overheads and bring things in cleverly together. So you bring containers straight into the stores. You don't put them through warehouses. You look at sharing the costs and reducing the costs as much as possible. And that's the environment in which you have to operate today.
Just how easy a process has it been, though? Because it's one thing saying it, it's another thing actually getting that job done.
What we've tried to do in War, what we've done is we've brought in a superb team. And so we've got a team of specialists in the logistics side, in the service side, in the financial side, and in the account management side to work with the retailers. And it's extracting maximum value out of each member of the team. So before it was really a salesperson heading the efforts. Today it's an integrated infrastructure working with your partners. That's
certainly been one of the group's focus points over this period. You know, we've seen the ongoing development of intellectual capacity, and that's enabling this comprehensive approach that you talk of. So run us through it and the kind of stride that's being made in that regard.
The first thing we as an executive team looked at is we looked at the technology, we looked at where the technology was taking us. And we said, okay, this is where we need to go, and we need to use technology as an enabler. So we looked at the whole process of the business cycle, from ordering the goods to payment. And we took that cycle and we've integrated, we've mechanized it, we've created portals, we've created e-billing, we've done that sort of stuff which has enabled us to work a lot closer with the retailers.
So how do strategic relationships that you've built over the course of the period fit into the strategy exactly? Because that continues to grow and strengthen as well.
Well, I think that's what the international players have brought to South Africa, is that understanding of that interrelationship and understanding of that technology. And then certain of the other South African retailers have looked at the competitive landscape in the South African market and are using that technology as well, probably even better than the international players. So it's become, you've got to keep ahead.
In keeping ahead, acquisitive growth has been very much a part of your agenda. I mean, we've seen acquisitions of the TDK, Case Logic, Memorex, Bell, Zonix agencies, I mean, the Sentry brand as well. Run us through how that fits in your strategy as well, and whether you're leaning more to acquisitive growth or organic growth from here on out.
Yeah, it's a combination. What we'd like to do is to do a 50-50. Where there are brands that we believe will give us an edge from being international brands, we will acquire them. But we want a combination between good, better, best, and a combination between brands that we own and brands that are international brands. So it's looking to try and get that balance in the marketplace. Also, we need to look at what the retailer requires. And the more brands we can get on the truck, the lower the costs, the economies of scale, one invoice, one delivery with more stuff on the truck.
Looking at your balance sheet, I mean, you're still sitting with a net cash on hand of 204.4 million rand. In terms of future growth or future projects that you've got in the pipeline, what are we looking at?
Well, we've still got to pay. We took over Samsat. We took that over on the 29th of February, and we're making payment today. So that will take a hefty chunk out of our balance sheet, out of the cash. We've got some internal organic growth projects underway, And we have 2 or 3 acquisitions that we're looking at. We're still in the early stages, but we think that that will add to our good, better, best strategy of the different categories in which we operate.
Does it add to your gearing and your debt levels as well?
Well, we're quite fortunate. We have a strong balance sheet. And in these times, I think with the tough times that the financial institutions have been through, we're very cognizant of the fact of keeping our balance sheet strong and keeping cash on the balance sheet. So if necessary, we'd keep cash on the balance sheet and maybe borrow some for an acquisition, but we'll make sure we keep our balance sheet strong.
How are you looking to expand on the continent? Because that is really the story right now. When it comes to the consumer, it's not just about the South African consumer, it's about the African consumer.
I think you're absolutely right. About 2 to 3 years ago, we decided that we needed to look at Africa, and our market needed to be sub-Saharan Africa and the Indian Ocean islands. If we didn't play there, our competitors would, right, and they would take it away from us. So we went in very, very early, and we went in with probably a shotgun approach. We looked at agents, we looked at direct distribution, we looked at the South African retailers, and we did a combination. Today, we've grown it from less than 2% of our revenue to over 7.5% of our revenue. We supply the South African retailers. Some of them we supply directly from here. Some we supply through agents based in Africa. We supply other retailers. We're supplying the goods appropriate for the different markets. We're even developing our own goods for the African market under our own packaging labels, under English, Portuguese, French.
Have your fingers been burnt? Because it's not easy terrain to navigate when you're entering the African continent.
You always learn lessons, and the lessons are always financial, and they're always hard lessons that you learn. But if you don't learn those lessons now, they're cheap at the moment to in actual fact learn. And I think the first thing you learn is you've got to listen to the consumer in the market. You can't take what you're doing and think it's going to work.
Exactly. So you're not taking a business model, a South African business model, and plugging it in. Adaptability has got to be key for a company like yours.
You've got to work with people on the ground that in actual fact understand. And their first words are, you don't understand.
Well, let's leave it there. Alan, thanks so much for your time this afternoon. Of course, Alan Coward is CEO of